Hello, everyone. I'm Kip Pogrebenko, the host of Amazon Operators podcast. And this is our episode where we dive into the importance of Amazon unit economics and the importance of external funding for businesses that want to grow and scale. I have a guest today, Nadav Gorlitsky, who is the CEO of Capec.
Hi, Kip. It's great to be here. Will be great to talk about how you can grow your business from experience. Personally, I've been selling on Amazon for over 10 years, multiple brands, all seven figures, lots of experience. Have been through all the ups and downs of running an Amazon business.
Nice.
And I'd be glad to share a lot of what I've learned in the past years and how we feel that Capec is the best solution for growing your Amazon business in a steady way.
Awesome. Thank you so much, Nadav, for giving us a brief intro into how Capec came into existence based on your years of experience as Amazon seller. And needless to say, the topic of Amazon unit economics is near and dear to you. So without further ado, let's look at the quote about unit economics, not necessarily related to Amazon, but in general. The quote is by Mark Andreessen. He is a co-founder of A16Z, very well-known fund. But most importantly, Mark Andreessen is considered the grandfather of e-commerce because they created Mosaic internet browser. This is when the history of modern internet has begun, if you will. And according to Mark Andreessen, unit economics ultimately determines the long-term success of a business, and no amount of funding can save a company with fundamentally flawed unit economics. So when we talk about Amazon, we talk about direct revenues and costs associated with a particular business model. And we want to look at that cost on a per unit basis, and why it's important to understand the unit economics and have a good grasp is because we can understand a business profitability just from a single sale or transaction before evaluating overall financial performance. And also it allows us to look into costs associated with a particular business model. And we can look at customer acquisition cost, customer lifetime value, gross margins, and also all costs associated to be able to make that sale. Yeah, just to reiterate the importance of understanding unit economics, we can look at the following statistics, which says that 29% of startups fail because they run out of cash. And most of the time, due to mismanaged unit economics, or maybe they didn't pay enough attention to unit economics and didn't spend enough time on financial planning. And what I mean by saying this is that, you can approach any business owner and say, hey, how much revenue did you make last year? And someone can say, hey, we made like 2 million in revenue. But when we ask about profit and what the profit margin is, and if someone is going to tell us, it was 5%. So Nadav, correct me if I'm wrong, we can clearly see that this is not a viable business model.
That's correct. Yes, we see that all the time. Customers that come to us, since we go into the true profitability of every product, we analyze the store, we analyze the products. When I talk about how we work, you'll understand why. We're basically partnering with our customers to help them succeed, to help them grow. And that's why it's very important for us to really understand the true potential of a product, the profitability of a product. And when you drill down into those real unit economics, as you're mentioning, you can learn and understand that in many, many cases, many sellers didn't look hard enough or strong enough at the full expenses that are dealt with selling a product. Some are fixed costs that have to be spread out on the entire cost of each unit, and some are per unit costs. And when you put all those together, especially advertising today that sometimes fluctuates between different periods during the year, that can really affect whether a product is profitable or not. And yes, in so many cases, we talk to clients and they say, I made $2 million revenue, my profits are 20%. But when you look at their bank account, where's that $400,000? They don't even have $50,000 to show for it. And that's why it's very important to really understand your true costs and planning the right cash flow that will meet those expenses, because that's where most sellers fall. And we'll talk about that, I think, much more as we move along.
Awesome. And 29% of failed startups is a pretty high number. One of the reasons why it happens is because by analyzing unit economics, we can really look from two perspectives. One, what kind of value would we deliver to customers with our product? And then how we can prioritize that value that we provide, right? And then it could be anything like marketing strategies, cost of customer acquisition, or maybe retaining and comparing it, to the revenue generated. And the second pillar, which I think is much more important, is business expansion. So, for example, you reach a point that you feel like your business can scale, and you understand that you don't have enough capital on hands, right? So then growing from that point will be really tough. And then if you're not doing this in a timely manner, your competitors will surely do.
Yes, I think when it comes to business expansion, especially in the Amazon space, it's such a dynamic infrastructure and market. I mean, we have 400 million customers just on Amazon.com. If you have a successful product, you can basically grow it times 4, times 5, or even times 10 in 1 year. And it's just a matter of meeting demand and being able to always have that inventory in stock and continuing your growth, your marketing, your success. And especially in Amazon, it's so hard when everything that you invest in when it comes to growth is basically creating real estate in the Amazon space. So whether it's reviews, whether it's your BSR, whether it's your organic sales, or even your advertising, if something happens along the way and you run out of inventory, or you run out of, you stop marketing, or you stop what you're doing that is working, you end up losing all that real estate and all that investment, and it just falls back really fast compared to other businesses where retail or stuff like that, their growth is a lot shorter, a lot slower, because it's based on physical people coming to your store. But on the other hand, it's also more lenient. If you run out of inventory, they'll come back tomorrow or the day after. Here, once you lost it, then you really lost your position in that place. So it's so important to plan ahead when you want to expand and grow, and do it the right way, so that you don't end up doing really big investments that end up just falling back.
Got it. Thank you, Nadav. That was pretty informative. So let's look at unit economics from a very conventional point of view, right? So, and then in order to do so, we have to look at the profit, and profit is equals to revenue minus cost. And if we look at Amazon ecosystem, then we can really dive deeper into each component of those costs, right? Like on one hand, we have gross profit, and then it equals to revenue minus cost of goods sold and minus Amazon fees. And then when we subtract refunds from gross profit, right, we have gross after refunds. And then from there, we keep subtracting marketing costs, which brings us to profit. And then the ultimately net profit will be profit minus reimbursements. All those costs can be broken down into two categories: fixed cost and variable cost. And it was a very good example that you, Nadav, made when you compared e-commerce online businesses and old school brick and mortar retailers with a much slower pace of sales compared to what is happening on Amazon.
Yes. So definitely, I need to understand very well each one of these spaces and their expenses and what they're built out. And another important thing is also understanding the cash flow of each of these costs. And I think that's the one thing that's most important, is understanding really what in what goes into all the different costs and how you can build it right, understand them, and try to utilize every little part of them, whether it's your shipping cost, your import cost, your manufacturing cost, your sales cost, your fixed costs. I mean, there's a whole long list of costs that we have as sellers online, and we really need to know them very well and understand where we invest our time to improve our costs so that we can raise our profits. And sometimes we also have to just raise our prices too. Don't be afraid of that.
Oh yeah, I mean, it depends on your pricing strategy, right? And then type of the product that you're selling. Like often, if you're selling like premium products, you definitely want to avoid window shoppers, so to say. They visit your Amazon store, they waste your ad dollars, but they never buy, right?
Mm-hmm. For sure, yeah. And also, it's very important. Also, I think we'll talk about this a little later, but understanding what stage you are in your business. If you're just starting off, if you're doing your growth spurt, if you're launching new products, each one of these stages has a different look at profit, expenses, and what we need to do in order to pass that stage in the business.
Right. So we can call it resource allocation process, right? Like when you're just starting out on Amazon, you kind of know your value proposition of the product market fit, but then you keep iterating until you find your 100% profitable strategy. Then your resource allocation process is different, right? Because now your business is entering into the growth mode as opposed to looking for product market fit. And this is when you need external funds to scale and to scale rapidly. Alluding back to your previous comment, like everyone wants to grow fast on Amazon, and because Amazon businesses do not operate on a brick and mortar basis, right? Like, so we kind of don't have to take into account like your rent of your space, like anything that is related to fixed cost that goes into brick and mortar business model.
Right.
So let's look at the next. You mentioned earlier that we have to look deeply into each of those boxes. So, like, I want to bring on the screen a cost of goods sold, and it contains purchase price, freight cost, custom cost, warehousing cost, and FBA cost. Right. So all those costs can be broken down further into two categories, as we mentioned earlier: fixed cost and variable cost. And then these are examples of fixed cost and variable costs. On one hand, we have operations, all your VAs, salaries, rent, software that you may use, including profit whale software, sponsor ads. And on the other hand, you have variable costs, marketing costs, manufacturing, inventory costs, which heavily dependent on the volume that that you manufacture.
Yes. So when looking and breaking down all your costs and your cash flow, this is very important because you need to understand at the end of the day, every business has a certain amount of capital that it's working with. Whether it's your own capital or if it's external financing, you have a certain amount of money you can work with. And that money needs to be spread out on these expenses. So, and at the end of the day, each investment of that, using that money, has an ROI, and you get money back from investing it. Whether I'm investing in operations, obviously I need that run the business. My VA has to do customer support. I need to pay salaries. I need software that improves my operations so that I need less operation expenses. So every investment in money is supposed to give some kind of return on investment when you do this. So it's important to understand how much money you need for each one of these different costs and where does the ROI come from. So if it's fixed cost, in most cases, those amounts don't change and it's part of operational costs. The variable costs change very much. Whether it's if you're a private label seller, you're manufacturing, so your cash flow is very different than a wholesaler that might be buying from a supplier and selling it a month later, and he has easier, steady cash flow because he can buy product, he gets it faster, he sells it the next month, and he gets an ROI within 30 to 60 days. If you're a manufacturer, you have to connect to the cash flow of manufacturing, which is usually 30% deposit, a month or two later, 70%. Then you have to pay the shipping. You have to wait till that product arrives to Amazon. And then usually it's 3 to 6 months to sell off that batch of product. So that's your ROI. And that's the cash flow you need to connect to. Marketing costs are usually very, very fast ROI because you invest money in advertising. Usually you only pay that advertising, whether it's through credit card or through Amazon, on your next payout. So you've got 2 to 4 weeks of zero payments on that advertising. And the sale you also get back from that advertising pretty immediate. So advertising costs, a lot of times people are afraid to invest in advertising, but it's really an immediate ROI. You don't even need financing for advertising in most cases because Amazon is subtracting it from your sales. So as long as your advertising at least makes back the sale, you're not really losing that much money in it, and it's very easy to invest in it. But the manufacturing, which counts for usually 80% of your capital, is the most important part when managing your cash flow, because that's where you'll find yourself losing stability, losing steady cash flow. You might find yourself putting a 30% deposit with a manufacturer and not having the 70% when it's ready a month later. And now your inventory is delayed. You're going to run out of product, or you don't even have enough to order enough product to meet the demand that you want. So if you can find a way to really create steady and good cash flow on your manufacturing, that usually steadies out most of the business cash flow and problems. And as someone who's run many businesses, and I'm sure everyone's here been there, when you don't have money in the bank to pay for something, or you don't have the salary, and that's part of every business, it's you have to deal with the ups and downs, but you're stressed out, you don't sleep as well, you can't really concentrate on growth and on the positive things and on the success of your business, because you're always dealing with trying to put out problems and fires because of bad cash flow management. So it's very, very important, I think, to really understand this and invest in it and try to build the right future and schedule that allows you to really invest your time and your concentration on growth and successful things.
Got it. Well, that was a pretty good explanation. So according to your experience, the business owners who have easy way to tap into a backup source of funding, they sleep better at night than the otherwise.
Definitely. First of all, if you look at any business in the world, even Google or Microsoft or whatever, they use external funding. Even when they're on the stock market, they're getting money from investors. Everybody uses external funding for growth. It's almost impossible to be able to meet demand and potential growth without external funding. I mean, even a private label seller, hopefully you're making 70 to 100% on your cost of goods, meaning for if you $10,000 that you bought inventory, you should be getting back net profit of about $7,000 to $10,000 profit. So you get back $17,000 to $20,000, right? But that's just doubling your inventory in a period of almost 8 to 9 months. In most cases, we're going to do a lot more than double in 1 year. And we have to order the next order of inventory before we even got back the money from the first order, because otherwise we're going to run out of product. So in all cases, you usually have between 2 to 3 orders in parallel of inventory, and hopefully it's larger and larger inventory growth, meaning you can never meet the demand and the potential of your growth without adding more capital into your business. So you need to bring that capital in order to really get the true potential of your store. So as long as you're growing, you want to be able to have as much capital as you can to get that inventory. Also, while you're growing, I believe, and most businesses work this way, it's not as important if you're making 70% profit or 50% profit or 40% profit or 100% profit. If your true goal is to bring your business to a 7-8 figure business, you can make a little bit less along the way, but get to that place that you want to get to. Because at the end of the day, we're always investing back into our business, and we're always going to try and grow the revenue. And once we have steady revenue and we've reached a point where we want to be in, then we can start tweaking our profitability. Also, as you grow, a lot of times expenses become lower, because if right now I'm only bringing LTLs, less than a container, then obviously when I reach a level that I'm bringing full containers, my shipping costs are going to go down.
Yeah.
My manufacturer, if I'm only ordering 3,000 or 10,000 units, when I'm ordering 30,000 units, I'm going to get better pricing on my manufacturing. So everything, as you grow, hopefully the pricing, your profitability will also become higher and grow with that. So you're going to have much more sales, a lot more revenue, and in most cases, better profitability when you reach the higher level of sales. It's very hard to look at profitability when your revenue is still in the six figures, especially in the low six figures. It's hard to have any profitability. So the point is really to find a way to grow fast, to grow to your potential, and then start tweaking your profitability when you get there.
Right. Because as you mentioned earlier, like 80% of your capital is invested in inventory, right? So when you analyze a business, let's say by using a Porter's framework, one of the pillars of that framework is the power of suppliers, right? So when you do not have access to readily available source of capital, then you may be subjected to that power, right? Like power of supplier, meaning that your manufacturer can dictate some conditions that may not be favorable for you, but you have no other way just to accept it, right? And hoping that the situation will get better, and when you make enough, when you have enough cash on hand, you may change your supplier or manufacturer. So, can you elaborate a little bit more on this? Like when having easy, ready access to capital will untie your hands, and if you don't like your manufacturer or your supplier, you can easily change it, right? Like this is not so much important for wholesalers, because wholesalers, they change manufacturers and suppliers all the time, but for private labels, I think it has extreme importance.
Yes, so it definitely, and we've seen this in many cases with our customers. In some places, some customers are even working with a broker because the manufacturer has too big of an MOQ, and they don't meet that MOQ yet. So instead of making large orders for a period of 5 months, they're making small orders every month just because they don't have the cash flow. But as soon as they're able to have the capital that they need, and now they can make a larger order, they cut out the broker, they're working directly with the manufacturer. Or even the manufacturer now is giving them better terms and better rates because they're making larger orders. So as soon as you have capital, your manufacturer looks at you differently, and you can save in so many places. I mean, we've had multiple customers that just by tripling we finance up to 75% of a PO. So anyone who works with us basically can now quadruple their capital. If they have $100,000 with us, they can order inventory for $400,000 because we'll do 75%. So in that way, when they go to their manufacturer, a lot of times they'll get between 3 to 5 to even 8% or 10% discount on the product. They're gonna be doing a lot more containers or larger shippings, and they'll save more money there. So we see that in some cases, our customers can save between 7 to 12%, which a lot of times is even more than what we're charging for the financing. Yeah. So they work with us, they find themselves having quadruple the inventory on the same amount of capital. their ROI is growing from 70% to 250% on their existing capital, and they're able to really do a lot more revenue and grow their stores. So this is a huge advantage. And Capec, the way we work is that we're not a bank, we're not a financial institution. We're actually taking our years of experience in chain of logistics and purchasing and sourcing, and we're partnering with our customers to be able to get to their growth potential. And in that way, that's what makes us very different. We come and we check the product, we check your profitability. So in that way, you're also getting an audit of your store and your product, the whole potential, the category, everything. And if we decide that this product really fits and has potential, we're basically partnering with our sellers. So we'll pay up to 75% of the PO. The seller puts 25%. The seller's the product's gonna make 70 to 100% profitability on that cost of goods. We take between 7 to 12%. That'll be our profit share for the part that we funded, meaning the seller is now making 60 to 90% profit on all the risk that we took. And in that way, we're basically we're taking 75% of the risk with about 10% profit, where the seller puts 25% risk and gets all the rest of the profit. And in this model, because we're partnering, we're also looking more than just as a number or a finance. We're helping our sellers, whether it's improving their shipping, improving their chain of logistics, managing better inventory forecasting and how much to buy, when to buy it. If you don't really need, you shouldn't have products sitting for 6 months in the US in a warehouse if you don't really need it there, trying to maybe make smaller purchases. Once you have a partner that's always going to give you the capital you need to buy the product when you need it, and you have that stability and you have that confidence, you can start making smaller purchases, organized purchases, planning forecast of inventory better, which also improves a lot in your profitability and in the flow of sales and the flow of inventory. So in this way, we're partnering with our customers, improving their entire chain of logistics. And also, hopefully it doesn't happen, but if there's a problem, your listing got closed, your profitability is going down because of bad advertising, anything that might happen along the way, obviously we're invested more than the customer in the product. So we're going to be there to help you out to pass that problem.
Got it. So it sounds like you are not just yet another financial company or factoring company. You're really a growth partner that invested in the inventory of your customers as much as the brand itself is invested, and then given your experience as the seller and your team experience supporting other Amazon sellers, I think you can do like pretty comprehensive SWOT analysis, niche analysis of the business, analysis of the competition, and make certain recommendations to to increase the efficiency of capital.
Exactly, and that's exactly correct, and that's I think the unique proposition that we offer, and that's why we created Capec from experience, because I know that if I go to the bank and even they give me $100,000 today, I'm only gonna pay $30,000 to the manufacturer now, and then in 2 months I'll pay another $70,000, and then a month or later I'll pay the shipping and start selling the product. But by the time I sold the first unit, it's 4 months that I already had to start paying back my loans, if it's a bank loan or if it's an MCA or if it's other financial revenue financing that's out there. So if it doesn't connect to the true cash flow of when you have to pay your suppliers to when you actually get your money back, it's gonna make it very complicated to manage. Because if I have to pay back already, all these financiers are taking money back already from my revenue before I actually sold the product. That's money, extra money I have to find a way to pay. So it's either I'm not getting the true added capital that I lended, because 30 to 40% of it I'll have to pay back before I even started selling the product. Or I'm taking that money from other places that I wanted to use it for growth potential, new products, or even operational costs that I find myself with cash flow restraints. So with us, as partners, we actually pay the manufacturers and the suppliers exactly on the day they need to be paid. So there's no deployment of funds when it doesn't need to be deployed. And if there's delays in manufacturing, it doesn't affect the financing in any way. And the return, the repayments are connected directly to the sales of the product and when it's sold. So you don't have any payments along the way. Even if the product sells slower, we'll postpone the repayment so that you never have any cash flow restraints. You know, you're getting almost like consignment. You're basically getting a partner that will make sure you have as much inventory as you want in Amazon. And when it's sold, then you only pay for the product. And that, I think, is the ideal solution for any Amazon store that wants to grow. And like I said, with that type of solution, it doesn't really matter if it costs you 2% more or 5% less, because you're going to be making so much money off the profits that we're financing and you'll be able to grow, and that's the most important thing.
Right, because you are dealing not with like a traditional financial institution who may have limited understanding of dynamics of modern e-commerce businesses, and they do specific frameworks and they apply that framework, the underwriting frameworks, and they don't really care if it's Amazon e-commerce or like how much of your sales come from Shopify, for example. They don't really dive deep into those type of things, aspects of your business, as opposed to Capec, right? Like as the industry insider, a former seller, you can provide very good recommendations and valuable insights in order to have to run your operations, and most importantly, have to manage your supply chain, right? Because a pandemic has shown us how supply chain is the inefficiencies of all this, the inefficiency of supply chain. And then with the introduction of recent changes to Amazon inventory fees, I think the subject of supply chain management through external funding becomes even more important.
Yes, definitely. Like you mentioned, and as I said before, we're here to look at the entire supply chain, and we look at ourselves as supply chain partners. In some cases, also, it's like we insist on post-production inspection. Not every seller has been doing that, and we have partners that'll do that anywhere in the world. And a lot of times, we find things in the manufacturer, in the product, that's a problem. And in these inspections, a lot of times would save that listing. If that batch would have reached Amazon, that listing would have been dead. I mean, basically, the amount of returns or defaults wasn't worth it. So we're very familiar with how these things need to be done the right way. I mean, we've had situations where just by understanding and looking at every little details, like the address of where the product was picked up compared to where it's manufactured, compared to the manufacturer that we're paying. We've found a couple times where a seller was paying a broker and he didn't even know there was a broker in the middle. And once
Wow.
he understood that, he saved 20-30% on his
Yes.
saving hundreds of thousands of dollars a year. And these are things that we're so familiar with doing this, not only for ourselves, but now for hundreds of other customers. And so it's a huge added value that we're giving our customers, more than just a finance partner that's there to grow with them.
So this week, a news is being circulated about Amazon lending program that they're going to introduce certain changes, and businesses will lose access to capital provided by Amazon. What implications do you see, Nadav, for brands, and how Capec can help in this situation?
Yes. So definitely, we've heard that Amazon is going out of the lending space, and the reason for that, I think, is that it's not their main know-how, and dealing with collection and stuff like that is not things that they wanted to deal with. But at the end of the day, even their solutions that they were offering were not solutions that you can really count on for growing your business, because in most cases Amazon lending was invite only. You log in, you suddenly see, hey, we can give you $100,000 now. When these situations happen, in most cases, you take that money. It's not, you haven't gotten it in the exact time you need it. Like we mentioned before, 80% of your cash flow is inventory, and it needs to be deployed at very certain moments in time. So if you have money that you're receiving now, not exactly when you need to deploy those funds, you're basically paying Amazon lending a lot of money, a lot of interest on time that those funds are not being used in the most efficient way. And on the other hand, cash flow wise, they're taking from your revenue already the next month later, which obviously any money you got from them has not started receiving any ROI. It's maybe you've started investing it in the next month or 2 or 3, but your ROI is only going to come another 4 to 6 months later. So you're going to find yourself that they're taking from your revenue and lowering your average income very immediately, and suddenly this chain that you're going into, you're going to find yourself taking. We've seen so many customers taking more Amazon lending or more revenue lending just to cover the cash flow expenses of their old lending, which is creating a snowball of debt.
Yeah.
That is not just because they didn't choose the right type of financing to fit their expenses that they want to use it for. I mean, if you want to use revenue financing for advertising where there's a fast ROI, yeah, that would work. That would fit. If you're a wholesaler and your ROI is fast, 30 to 60 days, great. That would also fit. But if you're a private label seller or a manufacturer and your ROI is usually 6 to 9 months, if you take any revenue financing, you're going to find yourself in cash flow restraints for sure. So I don't recommend it in any way. And I think it's only a positive thing that this product is not out there for Amazon sellers anymore. I think we've seen so many customers that have transferred to us, paid off their Amazon lending, and have now steady cash flow, steady growth, and understand how it was harming them in the past. And now that they can have a steady cash flow, they're growing, and they're growing very fast and a lot more safer too.
Got it. Very cool. So let's maybe shift gears a little bit, and perhaps you can explain the process, the existing process, of engagement with Capec, and maybe a certain level of expectations to set before, like brands make decision to, like engage with Capec.
Yes, no problem. So, like I said, we're a partner, so we don't really look at your personal credit, your business credit. We look at the exact product that you want to buy. The process is to file an application on our website. Then you connect your Amazon store through API. We pull in all the data, all the history. We want to see that you're selling. Usually, we want to see a revenue of at least $20,000 a month, and a product that's been selling for over 6 months, and a store that has been active for over a year. We need that amount of history so that we can really understand the potential of that product, the steadiness and the success of that product. And if we see that all the parameters fit, then we can basically come and join with and finance the POs that are needed to grow and to order more of this product. It's a very fast process. Once you connect the store and give us the PO that you want to purchase, usually within 48 hours, you can have an offer from us. Once that offer is approved, we sign. It's best that you talk to us before you even make your order with your manufacturer, because then you know that you have the financing, that you can purchase more inventory, you can buy as much as you need, knowing that we're going to pay the 70%, 75%, so that you can really buy the amount you want and not worry about the ROI, because it will only be paid back as it's sold. Once the once the deal is approved and we sign, then we do have a process of documentation, because like I said, we do require post-production inspection. You need to bring the invoice. We're always the last part that's paid through the manufacturer. So if we finance 70%, in most cases, the seller will put the 30% deposit and we'll pay the 70% when the product's ready after post-production inspection. And that's the process. But there's no personal guarantees. The only collateral we take is the product that we paid for, basically.
The inventory.
That's the inventory itself. So we're partners on that. And the fees are also very clear cut. There's no hidden fees. There's no monthly fees. There's no setup fees. There's none of these things that other finance institutions might have. It's just a fixed cost on that inventory that we bought together. And you know exactly how much is going to be paid back when the product's sold every month. And we built the repayment schedule also to match the sales rate. So if we're buying product for 3 months, then you won't pay anything until it reaches Amazon and starts selling, and then it'll be 3 payments. If it's 6 months, it'll be 6 payments. Also, another important factor is that if you have payment terms with your manufacturer, and you should always try to get that because that's free money basically, then we connect to those payment terms. So if you have net 90 with your manufacturer or net 60 and you only pay them 60 days after it landed in the US or after it left the factory, that's when we'll pay the manufacturer. So you only need from us another 2 to 3 months maybe to sell off that product. And that would also mean less time in the deal and a lot of times less fees also engaged in that.
Yeah, and I think the substantial value add of working with Capec, from my understanding, is your experience in the space, right? Like you understand all the dynamics of marketing costs, implications of challenges with supply chain, implications of like not sold inventory and all those things. So like your underwriting process includes the understanding of the business and of the industry in general, as opposed to like traditional financial institutions.
Completely. And when we come back to our customers, a lot of times we'll come and say, hey, look, right now we see that you're not profitable because your tacos is at 30-40%. But we understand you're a growing product. You're still launching. It makes sense. If it's a product that's been selling for 2 years and your tacos at 40% and your net profit's only at 5 to 6%, then obviously there's a problem here, and we'll come and say that, and we'll try to find ways to help you improve that. And in some cases, it doesn't mean we won't finance. We might just, because it's a little riskier, we might finance less. We'll only partner with you on 30-40% of the product, not 75%, because there's a higher risk, but we're still there to help you grow. And once you work with us, we'll also try to help and improve the product statistics and the economics of that product so that your store can grow bigger and have more success. And then we feel more confident to do higher levels of financing.
Yeah, so pretty much you operate kind of like a VC and like a venture capital firm, because you have skin in the game, and it's in your best interest to make sure that inventory gets moved as fast as possible, right? Like to get that turnover.
Exactly. In that way, we're exactly like an equity investor, except we don't get any equity. So
non-dilutive equity.
We're taking 70% of the risk with zero equity, but we still know what we're doing. So fortunately, all our customers till today have been very successful, and we have hardly had any situations of default, because we take our experience and we help our customers and we grow with them. And at the end of the day, we're seeing that it just works that way. If all the economics and the time flow is managed the right way, then the success just happens.
Okay. Our discussion is coming to an end, and I do have a question. You did mention earlier that you have certain requirements in order to start working with prospective customers. and those requirements is like being a year in business, at least 20 grand in revenue. What about businesses that didn't manufacture product yet, but found a viable product market fit, did like, good analysis of the niche, good analysis of competition, and have like a pretty solid plan, business plan to start manufacturing product and sell product. So can they come to you and seek for funding?
So if it's an entirely new business and new product, then no, we're not the partner for that. And you don't really need a lot of capital in order to try out a new product. In most cases, you can do market fit, some testing like you were mentioning before. And once you see that you have a good market fit, then we're great for the growth. But when it comes to after you've stabilized a certain product that's working and growing, and now you still have to expand your business into new products, bringing more variations, bringing maybe enlarging your category or and bringing more products in your category. In those situations, the fact that we're financing up to 75% of your main products, you were basically freeing 75% of your existing capital that you can use now for, let's say you only need 50% for the growth that we're putting in, and the rest can go into research and development and creating and launching new products that then once they start selling and growing again, we will be able to finance their growth. So you don't need a lot more capital to bring those new products for launching. And when you even know you have the partner that once they're successful will give you what you need for the growth, that's where the main amount of the capital is needed. So that's how we can help even when it comes to expansion into new products.
Very good. And I think that's it for today's episode. I hope it was extremely informative, given recent changes with Amazon inventory fees and Amazon lending program. I believe that Capec can help you and close those needs that your business may experience in order to grow and reach new heights. So thank you so much, Nadav. I really appreciate the time. And then for our listeners, if you think that this content is valuable, to please share with your network, and we will be super grateful for that. Thank you.
Thank you, Kip. Thanks for having me. It was great. I really hope that sellers take our experience and our know-how to help them succeed. And we're always here to available for any questions. And I think we'll also add the link that anyone who wants to file for an application and be able to get a free audit of his product. We'll be glad to give data and information on the potential of that product.
This is very good because we can create very good synergy here, because oftentimes our customers do ask about external funding required, to grow, required for rapid growth. And I think now I know where to send them.
Great. Thank you.
All right. Thank you so much.